got $1 million. You want to retire. How much can you live on off of $1 million in pre-tax money versus how much can you live on $1 million in Roth money? That's what we want to look at. There's tons of hypothetical things that could happen here. You could have more expenses in healthcare. You could have less than Social Security. There's a lot that goes on, but I just want to look at the basics right this second. If we haven't met, Eric with Jazz Wealth Managers, where we don't just invest your dough, we like to educate you on it. And so let's go ahead and dive in here. I'm going to show you a quick plan of exactly what this looks like. This is Louis Armstrong, and this is Nest Egg, which is the planning software we like to use here at Jazz Wealth for our clients. As far as expenses go, we're not as worried about his pre-retirement living expenses. We just want to jump over here to his goals. Louis is 60 years old. He's retired. He retired at 60, and he wants to live on $4,500 a month. Now, let's take a look at his net worth. Now, his net worth is $1 million here on the investment side. He does have some property, but to make everything simple, I said, you know what? His property tax, everything is included in that general expense of $4,500, including healthcare. So that's what we want to look at there. Now, he is going to have some income coming in. He's going to start his income at 67 years old. Projected estimate right now on the Social Security estimate would be $2,000 a month. So we do want to factor that in. And then we have one other really big thing that you always want to look at, and that's how you're actually invested. So as far as investments go, 60-40 allocation. So that's what we're wanting to look at here, because the more aggressive you are, sometimes the more money you could live on. Sometimes. Just all depends on the markets, how much money you have. There's a lot of variables there. So let's take a look at exactly how this looks if we break all of this down as to how much Louis could comfortably live on. And I'll explain this if you haven't watched our videos before. Let me explain what this means. 81% probability of success. As a financial planner, I'm comfortable saying, hey, you've got this, because every year you're going to reanalyze your financial plan. Maybe the markets fell significantly and you have a lower probability of success. Well, guess what? We could say, hey, we need to cut back a little bit these years. Maybe you don't take the trip to Europe. Instead, you just, take the cruise around the state of Florida or something. You've got to figure out what's best for you, though, when it comes to this. But that's just kind of a simple strategy that we like to talk about. Now, keeping it basic, this is just the Monte Carlo analysis. It runs 1,000 scenarios to show you the world's best market in a sense and the world's worst, and tries to find a median line, because we all know that the markets don't just get a steady return every single year. So he could live on $4,500 a month comfortably and have an 81% probability of success. And he's projected to leave, roughly $653,000 to his heirs. That's all pre-tax money. So that's what that's going to look like. So let's go ahead and change this up a little bit. Let's say that, now Louis doesn't have IRA money. Louis got Roth money. So if we take a look at his Roth money right here, and we're going to say we're going to leave everything else the same, everything exactly the same, 60-40 allocation. So it's going to show, obviously, an increase there. You're at a 92% probability of success, but that's not what we want to look at. We want to say how much more can he live on each month versus the pre-tax. And so if we break this down, if we say, hey, everything that we have is in Roth, let's take a look. I believe that is the number. I actually had already done a little bit there. And so we're going to say he's got an 81% probability of success right there, just in line with what the pre-tax was. But now this is on Roth. He's spending $525 more per month. Now, not only is he spending $525 more a month, you have to think through that not only is it just the $525, it's also the compound interest off of that when it comes to inflation. So if we're calculating in here on our plan a 2.5% inflation rate, that $525 is going to continue to grow more also. So in the end, it's going to be exponentially more that he is able to retire on by having all of his money in Roth. Now, is that the best route to go or not? There's a lot that comes into play that you have to analyze to say, should I do pre-tax or should I do Roth? It's a huge debate. Oftentimes, the rule of thumb is if you make more now or you're in a higher tax bracket now than when you retire, then you should just do the pre-tax and then later on maybe even convert to Roth. I'm going to work on this. I'm going to have a video, do a little teaser for you, tell you we should have a video coming up possibly this Friday that Dustin and I will talk through that a bit more. So if you haven't checked us out, check us out at jazzwealth.com. We'd be happy to help you here.
Thanks for watching. If you want to watch more FinTips videos, click here. Be sure to like and subscribe also.